Hi guys, this is Simon with Trade and Perform Coaching doing the trade review for Friday let's see, what were we Friday, the 22nd. And really, as much as a preview, this is going to be a little bit of a review, this is going to be a bit of a preview as well. Reason being, there's not a whole lot going on. We're stuck in a massively tiny trading range from 2119, essentially 2120 to 2130, right? 10 points. Essentially spent all of last week there. And so that brings up a couple of points. The first point is uh, what I'm looking at or what I'm looking for in my own trading and the people I coach is two things. First of all, to break the boom bust cycle that almost every futures trader goes through. Um, Whether that's a weekly boom bust cycle, monthly boom bust cycle, or the worst that's identified by Dr. Brett Steenbarger, which is the 3-year boom bust cycle. And my primary concern is how do I get through from a day to day, on a day-to-day basis with a large objective of keeping my equity curve looking something like this over time. So the first thing that we have to kill is the boom bust. The boom bust cycle, their equity curve looks more like this, or even worse, like this, right? And this is the equity curve of the majority of retail traders. Why does it work like that? Quite simple. The market has a market cycle that usually changes every quarter. And if we look at a bigger picture here really quickly, let me see if I can do that and pull up a 60-minute chart. That help. Let's widen that out. And as you can see, the main characteristic that's been in play really since you know what, I'll need to pull back data. Let's go. Okay. The primary way the market has functioned really since the beginning of the year, if we pull this all together, has been when we're at the top of the range, meaning the very, very tippy top of the range, we've been identified by these really tight, narrow ranges, right? And then as the range expands towards the bottom end of the range, which has been, we've kind of had this upward lifting bottom end of the range, right? But as we've been getting towards the bottom end of the range, it's been expanding, and more. The other part that's making this market difficult is not only do we sit at the top of the range in real tiny, narrow trading ranges, but we've had a tendency, instead of having movement that works kind of like this on the way down, and then like this on the way up, it's been more directional, much more directional, meaning pretty much straight down, and then occasionally we get these kind of sideways moves, but most of the time these moves up, you can see we went pretty much straight down here, and then we go straight up, and it's deceiving on the moves up, right? You say, well, it looks like there's kind of two-way market, and there kind of sort of was, except if you look, we gap and then we trade sideways, right? We gap, we have these narrow grindy days, we gap, narrow grindy days, and so the upside hasn't been that easy. The downside has been pretty fast and brutal, and it's made it harder to, in my opinion, it just made the entire last 3 months really a difficult trading environment. However, at least when we're down in the bottom part of this range, there's enough rotation size where we can pull off multiple trades for what my goal is normally is 2 points plus trailers, so 2 to 4 point trailers. In this area, are relatively easy to get, and we get multiple shots at them through the course of the day. But when we've gotten to the top of the range, it's really, we get pretty lucky to get 2 or 3 shots at 1 to 2 point trades, right? So that's been the biggest challenge. And if we look at this week, we would have expected on a breakout, we would have expected the market to really kind of take off. What we would have wanted is something that looks like this, right? If I think if you talk to most traders, that we would have had price action to look something like this, except that price action would have taken place up here. Instead, what do? We broke out to new all-time highs and we immediately consolidated. So for me, at least right now, it becomes pretty clear cut. If we can hold above, we either need a gap above and break away from this 2130, and we should be able to drive. My concern is we won't get this drive. We could simply have a stair step up type of action, or what I'm hoping is that we will gap below 2120 and at least come in for this gap fill down here, which is roughly 19, I want to say it's 1995. I'm not going to break it down closely enough, but what I'm thinking is that we probably have a potential, if we can get and hold below 2120, to come in and do a gap fill, and essentially this will be a pullback to break out type scenario. There's nothing really bearish out there in terms of data or news information. Everything's been fairly bullish, and we have not had a 10% correction. Gosh, I think it's been 3 years since we've had a 10% correction, and there's pretty much a worldwide QE. So I'm not particularly bearish, but I am hoping that we can come back and tag this open gap just like we did here. You can see we left this open gap, we gapped away, we came all the way back down. Just as soon as we filled it, we filled that. Here, this is what I'm talking about. We left an open gap back over here. We gapped up, we traded sideways for a day or two, came back in, right, filled that gap, and then immediately took off. This move is essentially a move from 2080 to 2125, roughly a 45-point move, right? So if history is going to repeat, I think we have a decent chance of that happening. We could come back in here and fill this open gap. I'm going to assume that last week, because it was a holiday week, we had a relatively slow week. I'm hoping that we can come in, fill this gap. This essentially becomes a pullback to break up to the upside. Now, if we pull back to this open gap at 2095 and we fail to get back above 2119, there's also a key area at 2110 and a quarter. If we fail to get above those two, then that does open the door to come down and explore these areas down at 2060, and then we are poorly auctioned all the way down to about 2045. However, I don't think looking at the structure and the way that the market's been trading, I don't think I want to try to trade for a scenario that's going to get us to this level. Obviously, I'll change my tune relatively quickly if we come down to this open gap and we fail to come back and get a backside test, or we fail to simply get back above 2120. We'll know, right? This will probably take a little bit of time to play out, just like it took time to play out here, right? This took almost, between the time we first tagged 2120 until the time we had 2 attempts at retesting it, and actually 3 attempts. There was almost an entire month that passed where we stayed in this, essentially what turned out to be a 40 to 60 point trading range right in here. So how did we carry that through to last week and what was going on last week? So let's discuss that for a minute and see if I can tie everything together. The first thing that I'm concerned about when we're in a tight balance range is not over trading, right? What traders will try to do in this scenario is they will try, usually in vain, sorry, that's tomorrow's chart, there we go. Let's see, let's minimize this, let's maximize this, there you go. Most traders most newer traders, actually even some older traders, want to try to momentum trade ES. ES is a horrible momentum trade. Why? It has a tendency to revert to the mean quite often, meaning it balances a lot and has a tendency to come back to the middle of the trading range. Even on days where it's advancing, you can have several types of balance days. You have a balance day where the market's generally moving up, but it consistently comes back into the middle of the range. You can have a true balance day where we just literally trade sideways, and then you can have the opposite of this where we trade down. If you look through the course of what we had Friday, it met all the characteristics. First of all, we opened up. The first clue that looked like we would maybe even have some strength, right? We had the inability to test Globex low out of the gate. Market pushed up. But then look at our next clue, right? Here's our first hour ending. And by the end of the first hour, despite the fact that we were unable to hit Globex low, we were only able to rotate from 2124 to 2128. That's a 4-point rotation in the first hour. The average rotation through the course of the year on ES is 4 1/4 to 4 3/4. I generally know that if my rotations are less than 7 to 8 points in the first hour of the day, that we are going to balance through the course of the day. So what are the characteristics of balance? Balance has an inability to sustain new lows, an inability to sustain new highs, and generally after we hit new highs or lows after the first hour, they will tend to revert back to the middle. And you can see here was our first break above first hour's high, which was right here. What do? We reverted actually not only back to the middle, but back down to the very bottom of the range. We came back up again. This was a news generated spike. The Fed chair spoke, pushed us to a new high, and then from that new high we got exhaustion. Again, the range from top to bottom was roughly 21, 24. This is barely a 6-point range with our Fed chair speaking. Really very holiday-like, right? We break to a new high, push back to the middle, make an attempt to retest those highs again. No ability to hit Globex high or the high from Wednesday or Thursday, right? And then at the end of the day, we just got selling. Not very. Considering Friday was the day before a holiday, usually in a strong market on the day before a holiday, we'll actually get a push to the upside. The fact that we got a push to the downside is just indicative of what we had the whole week, which was balance, balance, and more balance. How do you survive balance? Well, if you look through the course of the week and after the first hour, generally speaking, if you look for key locations to test breaks to new highs, and we can also see that here on Thursday, break to new high, starting at this point right here at 11 a.m., push back to the middle, break to new high, push back to the middle. Now, if you're a momentum trader, and unless you bought the opening print right out of the gate for a push up, every time you try to buy a break here, you got about a 2-point rotation, and that was just about enough to stop every momentum trader out each time they were thinking they were going to break. Why is that important? Most retail traders trade with less than a 2-point stop, right? The gross majority of retail traders trade with a 2-point stop. So if you're buying every break and we're rotating back down, even if the rotation down is just 2 1/4, it's just enough to stop you out every time. And this is how a trader can come who's trying to trade momentum in ES and end up losing 6 points, 5 to 6 points on a day where there was barely any motion in the market in the afternoon, right? And we can see that pattern really held through the entire week. Hold on one second. This was a news-driven spike that we had here on Wednesday. But if you look through the rest of the week, all of this is balance. We finally broke to the downside. And this is key, right? Even on the downside, it looks like, oh, we're going to break down at the end of the day. What does it do? It moves right back to the middle of the range. Looks like we're breaking out. Moves right back to the middle of the range. So what do you do as an individual trader, as a retail trader? You look for signs, first of all, that either if we're in balance, the tick will be plus or minus 500 on the NYSE tick. New highs will tend to get sold at key resistance points and key rotation points. New lows will tend to get bought and pushed back to the middle. And that was pretty much the strategy that I ran all week long, was trying to trade balance and push back to the middle. My assumption is going into this week, if we come in tomorrow morning, if we are unable to trade, so let me shift the conversation, right? Because there's not a lot to talk about when all you get is day after day of balance. Your trade plan is relatively straightforward. I'm looking for a break to new highs or a break to new lows after the first hour, and I'm looking for exhaustion either via tick divergence or looking for large sellers or large buyers to step in and point out exhaustion via of some type of volume indicator, right? So that being said, the first thing I know that needs to be accomplished, I want to see if we can trade below Wednesday and Thursday's low. We were unable to trade above Wednesday and Thursday's high or Wednesday's and Thursday's low really since Wednesday, right? We've been balancing here. So I know if we gap above this 2132, right, I'm going to stand aside in the first half hour so I don't get caught in an open drive. I want to see if on the pushback down, are we able to sustain half gap? Are we able to get gap fill? If we're not able to get half gap or gap fill, that would be a sign of strength, and I would expect a directional move up and beyond 2130, perhaps to 21, probably given the ranges that we've had, 2140 to 2145, right? We just really haven't had any fuel to launch this thing in a major way. So if we were able to move to 2145, given that we closed at 2124, that would be a 20-point move, and it would be approximately almost a triple of the range that we've been having all last week. That would be about what I would expect if we have a range extension upwards, right? On the other hand, if we're able to get below and hold below 21.19 a quarter, I would look for a test of that somewhere between 21.05 to 21.95 if it really got ugly, but I do expect responsive buyers at that 21.95 to 21.05 to push back up. Again, if we gap below this 21.19 area, I'm going to simply stand aside for the first half hour for two reasons. First of all, I want to make sure that I don't get run over on the upside in an attempt to come in for gap fill, and I want to be able to watch objectively whether we can get half gap or gap fill. And then the other thing that I want to look to see is whether NQ is confirming or not confirming that move. As a matter of fact, if you look last week, the Russell 2000 dramatically underperformed NQ, and we'll see if it's able to pull NQ back down to the downside. NQ is still not broken out to new highs yet. We're just short by a hair, but still has not been able to do so. And I have a feeling that if NQ rolls over, it'll drag ES with it. If we open anywhere in between these 2 points, meaning if we open up underneath 21.32 or above 21.19, and we fail to get below those in the first 30 minutes to 45 minutes, or above here in the first 15 to 35 minutes, I'm going to assume a balanced day. And on a balanced day, I'm going to look for tick divergence. I'm going to look for a rotation to new highs after the first hour, and I'm going to look for location to fade those back into the middle, and I'll look for a rotation to new lows, and if rotation back up into the middle, my assumption will be balance if we fail to get below those 2 points for the rest of the day. And then I will also be keying off of the first hour's move. If the first hour we have a greater than 8-point range in the first hour, I'm going to actually start to look for a directional move one way or the other. If the range is 4 to 5 points, I know pretty much right off the bat I'm looking for balance. So those are kind of the keys to the week for me. 21.19 a quarter, 21.32 and a quarter, and then at the extreme, the 20.95. Those are the key areas that I'm looking for. The key test on the downside, the first key test will come at 21.15, followed a little bit lower than that at 21.10, and then if we get below 21.10, there's not much holding us back to testing that 20.95. There's not much holding us back from testing down there. So, but first things first. First, we have to be able to get below and hold below 21.19 and a quarter. The next big test comes at 21.15. So, I'm a little bit tired. I hope everyone had a great weekend. If we look on this volume profile, the last thing I want to do here real quick. If we look on the volume profile, what we'll see, let's get rid of this. Good stuff. And we draw this in, right? What do we have? We have a very tight, narrow, balanced range. Generally speaking, when you get a tight range like this, it's building energy for a move. The only question is the move up or down? And our first key to that will be trading again, holding below 21.20 or 21.19 specifically, or above 21.32 on the upside. I can show you an example of what that looked like before when we have tight balance, and how the market responded from that. And that is, if you come in and look in this area right on the bottom side, you can see something that looks pretty similar. You'd flip it upside down, right? But you go back to March 9th, 10th area where we had 4 days of sideways trading. You can see that we opened, traded out of the range, backside tested, and then finally had that large day up, right? Followed by 2 days of balance. And you can go and look at this 2 days of balance and see that we broke to the downside, range expanded. And then also on this first move back to the swing lows in March, if you look at this period of time right in here, from here to here, and on this date specifically, which would be, let's see if I can find it for you. I would look very specifically at this date, right here. March 3rd. Okay, the characteristics of March 3rd are very much what I'm looking for um, to see what a downside move might look like, right? And you'll notice that even in that downside move, it initially came back for it broke, backside test, then we got the swings down. And the other characteristic you'll notice, by the way, if you're waiting for a big downside move, guys, and this is something that I stress with my coaching clients, it's really quite difficult to pick up from an eye level point of view. Right? When you look at it, it'd be like, wow, it'd be great to capture this downside move. But you have to remember one thing: from the time the downside move starts and you identify it, which is probably right here, you had 1, 2, 3, 4, 5, 6 days of downside till we reach the bottom of the range. And then look how quickly, just in the equal amount of time, we swing right back up to the high. This is what makes being short in this market so difficult. Is first of all, you don't know when we'll get on a run like this, where it's just day after day grind. And secondly, even when we do get extensions down, they last for such a short period of time. You have to have your mind you have to have your mind at a point or in a frame of mind where you're just going to say, I'm going to buy the dips, even if you look at the majority of the closes on this downside move here. And I just think this is so important to my own trading and really to everyone's trading, right? In this area here, in this whole downside, we closed somewhat close to the lows here. We closed at the lows here. We closed at the lows here. Out of this whole move down, there was 1, 2, 3 days where we closed on the low. What does that tell you as a trader? If you were pressing your shorts all day long from a day trading perspective to the downside, you got smoked most days. You had to be balanced. You had to be willing to take longs and shorts, both longs from rotations up, shorts from rotations up and longs from rotations lower. And that requires that you train your mind and you gain the confidence to know that you can identify the levels and you can identify the rotation sizes that are going to pay you, and you can identify what the price action looks like when we're about to get a reversal. So I cover most of that intraday while I'm in the room with my traders. And at any rate, that's kind of the best outlook I can have going forward in terms of what I expect. Meaning, if we do get rotations down, I expect the majority of the days to look like this. I'm going to attempt, and I will not overtrade in an environment like this. I'm going to quickly identify whether we're in balance or we're moving out of balance, right? Because that'll address what size rotation I'm looking for, and not only what size rotation I'm looking for, but also whether I am willing to fade a move in one direction or another. I want to be able to identify, again, below 21.19. I know that we have a good chance of coming down testing 21.15, 21.10, and eventually 19.95. But I also know from each of those key locations that we're likely to get key rotations back up. So I want to have a willingness to take a long from those areas. And that's what I do in the room in real time, is identify those areas, identify the price action that'll give us profitable trades, and then where I can, I call out those profitable trades so that our traders can take advantage of them. So anyways, my name is Simon. It's been a little while since I've done a market trade review and preview. Hopefully this helps a couple of you out there, and hopefully I get a little bit smoother and better at doing this as we move forward. Anyways, I'm tired, and I think I'm going to go ahead and crash. I will talk to everyone tomorrow. So you'll have a great night. I look forward to making money this week. Remember, if you can't figure out what you're doing, don't allow your account to constantly draw down. Stop, paper trade. Make sure you have a written trade plan. You have pre-planned entry, exit, and stops, right? And what that does for you is that reduces the fear, increases the confidence, right, and allows you to become consistent. If you have any questions, you're welcome to email me at tradeandperform, TRADENPERFORM @gmail.com. And anyone who would like to come into the room for a week for free of charge, you're more than welcome. Simply send me an email requesting entry, and I'll be more than happy to accommodate that. I hope everyone had a great weekend. To all our veterans out there, thank you for your service to our country. I appreciate my freedom and the freedom of those around the world. Anyways, have a great night, guys. I will talk to you all tomorrow.